Picture this: markets trembling, currencies flickering like dying stars, and a silent signal flashing beneath the chaos. It's not in the headlines, not in the breaking news ticker. It's hidden in plain sight. A ratio, a whisper between gold and silver that's beginning to scream. The gold-to-silver ratio is collapsing, and fast. This isn't noise. This is the market's heartbeat skipping, warning those who can hear it that a massive transfer of value is already in motion. For years this ratio sat comfortably in the background, dismissed by analysts, ignored by traders, but now it's moving at a speed that only happens before big events, before corrections, before crashes, before fortunes are made and lost. This is the same indicator that has foreshadowed historic shifts in wealth again and again. When it breaks its long silence, you don't look away. You pay attention, because this isn't just a chart move. It's a reflection of confidence cracking, of the financial world questioning its own foundations. It's the signal before the storm, the moment the smart money stops pretending everything's fine and starts positioning for what's next. The gold-to-silver ratio isn't just a number, it's a pulse, the heartbeat of the entire precious metals ecosystem. It quietly tells you when fear dominates and when opportunity hides in plain sight. When you look at it, you're not just seeing a comparison between two metals, you're seeing the psychology of the global market distilled into one line of data. Every uptick, every drop reflects shifts in confidence, liquidity, and human behavior. That's why the smartest investors never ignore it. They study it like weather forecasters reading the winds before a storm. When the ratio climbs, it means gold is commanding a premium. Money is scared. People are moving toward safety. Silver, being more industrial, lags behind. But when the ratio starts falling, it's not just silver rising in price. It's a sign that risk appetite is returning, that capital is rotating toward growth and productivity. The ratio, in that sense, becomes a leading indicator of optimism or panic. It's an emotional barometer masked as a statistic. Historically, it has exposed turning points before anyone saw them. When it hit extremes 80-1, 90-1, silver was screaming undervalued, and those who listened reaped the benefits when it snapped back. That's the beauty of it. It doesn't lie. It just waits to be interpreted. You can ignore opinions, headlines, predictions, but you can't ignore mathematics. The ratio is pure math, and math has no bias. So, understanding it isn't optional. It's the difference between reacting late and acting early. It's a map of imbalance, and markets always correct imbalance. When that correction comes, it's not gentle. It's fast, brutal, and rewarding for those who saw it coming. That's why the ratio's importance isn't theoretical. It's tactical, it's strategic, it's survival for anyone serious about wealth preservation and timing. History doesn't just whisper lessons, it shouts them, and the gold-to-silver ratio has been shouting for centuries. Go back to ancient times, and the ratio hovered near 15-1, a reflection of natural scarcity and intrinsic value. Fast forward to the modern age, and it's been a roller coaster of emotion, policy, and panic. In 1991, it hit around 100-1, signaling silver's neglect. By 2011, that same ratio compressed to near 31-1, and silver surged like a coiled spring finally released. Every swing tells a story of imbalance and correction, of greed and fear trading places. These extremes aren't random. They're the footprints of human overreaction. When investors flee to gold, the ratio soars. When confidence returns, silver claws its way back, often violently. The data doesn't lie. Each time the ratio stretched to historic highs, a sharp reversion followed. That's the rhythm of this market, a pendulum that never stops moving, just waiting for momentum to shift. Understanding those extremes is like reading the market's autobiography. It's not about predicting perfection, It's about recognizing when the story is repeating itself and knowing when the next chapter is about to turn. The forces that move the gold to silver ratio aren't mystical. They're mechanical, psychological, and deeply human. Every shift in that number reflects a collision of economics, technology, and trust. Monetary policy is the first driver. When central banks print aggressively, gold responds as the ultimate safe haven. It becomes the anchor when paper confidence weakens. Silver, while still precious, dances closer to industry. It breathes with the economy. When growth slows, factories stall, and silver demand dips. But when expansion ignites, silver wakes up fast, and the ratio begins to tighten. Then there's the Industrial Revolution happening quietly beneath the surface. Silver isn't just jewelry, it's electricity, solar panels, medical tech, and every microchip that fuels modern life. As green energy and digital infrastructure expand, the hunger for silver grows. Gold has no such industrial chain. That imbalance is structural, and as technology deepens its roots, silver's utility becomes a more powerful force than speculation alone. Investor psychology adds another layer. When fear dominates, people hoard gold. When opportunity reemerges, they chase silver's potential. It's that rotation of emotion, caution turning into ambition, that drives the ratio to contract. Add geopolitical tension, inflation, and mining constraints, and the equation becomes even tighter. Silver mines are rarer, costs are climbing, and supply elasticity is weaker than most assume. All these forces weave together in a rhythm that repeats through decades. It's not magic, it's momentum. Each policy shift, each industrial breakthrough, each emotional swing pushes the ratio toward imbalance until the pressure releases. When it does, silver doesn't just move, it explodes. Understanding those drivers isn't just analysis, it's foresight. Because those who grasp what pushes the ratio know exactly when to step aside and when to strike. When people talk about the ratio collapsing back to 30 to 1, they're not just talking about a statistic tightening, they're talking about a seismic shift in value perception. A move that sharp doesn't happen in calm waters, it signals a storm underneath. If the ratio truly falls that fast, it means silver is surging at a pace that outstrips gold's stability, and that's not ordinary. That's capital fleeing the old balance and chasing something undervalued, something overdue for recognition. Such a collapse represents a reversal of decades of distortion. For years, gold has held the spotlight. Central banks, investors, and institutions piled in, while silver lagged, quietly building tension. When that tension releases, it's violent. It's wealth redistributing from passive hands to active ones. If the ratio snaps back toward 30, it means silver is reclaiming its historical relationship to gold, perhaps even reasserting its role as real money in an age drowning in debt and digital promises. This kind of contraction also matters because it exposes fragility in the system. It means industrial demand is outpacing supply, or that inflation is being priced in faster than policymakers can spin their narratives. It's the market saying, enough. For investors, that's not a time to react emotionally. It's a moment to recognize that asymmetry creates opportunity. Those who catch that move early understand that a falling ratio amplifies silver's percentage gains relative to gold. It's leverage, but not the kind built on credit, the kind built on reality correcting itself. When the ratio nears 30 to 1, it's the market rebalancing centuries of mispricing in one decisive move. And if history repeats, it won't crawl there, it'll sprint. That's why this potential collapse isn't noise, it's a signal, and it's getting louder by the day. The phrase goldtus, silver ratio collapsing back to 30 to 1 fast, isn't a headline, it's a warning flare. It means the quiet balance between two of history's most reliable stores of value is breaking down, and something fundamental is shifting beneath the surface. When this ratio starts falling rapidly, silver isn't just rising, it's overpowering. It's signaling that money, confidence, and risk are being recalibrated at speed. For decades, the ratio lingered at inflated levels 70, 80, even 90 to 1, an era that made silver look forgotten. But markets don't forget forever. When that compression begins, it's the unwinding of years of complacency. It's the system resetting its scales, stripping away the illusion of permanence. Silver, being both monetary and industrial, becomes the bridge between fear and growth. When investors realize that bridge is undervalued, they stampede across it, and the ratio collapses in real time. A move toward 30 to 1 would mean silver is no longer the side note, it's the headline. It would suggest supply is tightening, demand is accelerating, and capital is repositioning into tangible assets faster than policy can adapt. It's also a psychological shift, the market rediscovering silver's true leverage against gold's dominance. If history is any guide, these collapses don't unfold slowly. They come in bursts, months, not years. The speed reflects panic and opportunity intertwined, as traders scramble to catch the momentum before equilibrium returns. It's not about prediction, it's about perception. When the ratio falls that hard, that fast, it tells you the world's faith in paper promises is eroding again, and people are moving to what they can touch, weigh, and trust. That's not speculation, that's instinct. And when instinct takes over markets, it doesn't whisper, it roars. So let me leave you with this. The warning is out. The ratio is moving. The forces are aligning. This is not a passive moment. If you wait for the dust to settle, you'll be reacting, not leading. But if you step in with clarity and conviction, you'll be positioning on the right side of history. Remember, when the gold to silver ratio collapses toward 30 to 1, we do not just witness a shift in numbers, we witness a shift in value, in power, in timing. And whether you favor gold, silver, or a mix, you owe it to yourself to watch this metric, understand the drivers, and make your move. So ask yourself now, when this ratio moves, will you be ready, or will you be caught off guard? Thank you for watching. Subscribe, hit the bell, stay sharp, because when the ratio changes, everything else changes with it.